Startup funding stages. The following funding stages are presented in the evolutionary order relative to the development of a startup. Sweat equity. In the beginning of most startups, the founders will work on an idea for free. This is where things start. All the ownership resides with the founders at this point, and they figure out how to develop the business concept using their own resources. This is where hustlers and builders push the development of their company forward without outside funding. Like Teddy Roosevelt said, "Do what you can, where you are, with what you have." If your idea is compelling enough, you can enlist the talents of others to work for sweat equity. This may take the form of paying a computer coder to develop an MVP in exchange for stock in the company instead of cash. Bootstrapping. Bootstrapping is taking early revenues from the products and services developed with sweat equity. There is some outside money from early adopter customers, but not investors. This is an important milestone because it signals that there is a need for what the company is creating. It is a signal that the founders are resourceful and committed to finding a way forward. This is the kind of grit investors look for in founders. The 3 F's. This is usually referred to as friends, family, and fools, but I like to replace the last one with fans. Once a fledgling startup has developed the concept and identified some preliminary customer interest and has a clearer idea of what the next step should be, then it is time to tap the founder's personal network. This is personally risky because raising money from your grandmother or uncle and then throwing in the towel 6 months later can make for an uncomfortable Thanksgiving get-together. You want to be sure that you are onto something before hitting up loved ones and old college roommates. The first 2 stages move the idea along and also help develop discipline about how to parsimoniously deploy these precious funds in the most effective and efficient manner. Here you want to have a plan to get to clear milestones and deliverables that will be inflection points of added value and reduced risk. This plan needs to include a detailed budget of how to get from here to there. An entrepreneur needs to be scrappy and capital efficient. Self-funding. This is a select group that has the resources to fund the initial development. A serial entrepreneur who has sold previous startups are in this category. These are founders that want to focus on building an MVP without having the distractions of pitching investors before knowing whether the idea is feasible and customer interest is reasonably there. These seasoned folks also realize that the further along the business is, the higher the valuation for the company and the less equity they need to give up in order to raise capital. Incubators and accelerators. Incubators and accelerators are formal programs that accept startups and put them through a program to help develop their idea and present the graduates to an investment community during a presentation day. Founders can get a modest amount of funding from these programs. They also get credibility because they have been scrutinized, vetted, and accepted by an incubator program. Y Combinator is one of the most popular incubators, and they have had some great success stories coming through their program, like Dropbox and Airbnb. Crowdfunding. Kickstarter, Indiegogo, and others have made crowdfunding a viable option for taking projects from ideation to execution and prove market validation. These website-driven funding sites are attractive because they represent a funding vehicle that is non-dilutive. This means that the money raised is not in exchange for equity, ownership in the company. Other incentives besides equity are offered, such as exclusive access to the founders or early access to the product. A crowdfunding project can also act as a way to gauge demand and generate interest in a concept early on. Angel investing. This funding round is also called seed funding and represents the first professional outside investment. Most founders get their seed round after successfully going through 2 or 3 of the early-stage funding strategies discussed above. Angel investors are individuals who scout for great startup opportunities and generally make a lot of relatively small money investments in early-stage, high-risk ventures. They are essentially buying lottery tickets on the character of the founder and the potential upside of a company breaking out into a huge success. They look to make 100 times their money back if a company exits successfully after being acquired or going public. Angels represent varying degrees of professional investor, and they must be convinced of the potential of a startup to really scale and become hugely valuable. After looking at many such deals, Their greed needs to overcome their skepticism in order for them to invest. Series A. The Series A is the funding round where the company becomes a professionally organized entity, a corporation. Professional venture capital firms who, as part of the deal, join the board and create proper governance do this funding round. Proper governance means that the company is legally incorporated and holds regular board meetings and keeps a detailed record of board resolutions, all designed to increase the share price of the company. Prior to the Series A, founders run the show and answer to no one. Focus is on trying to find product-market fit. After Series A, the CEO will spend a significant amount of time, about 25%, managing the board and the legal requirements of running a corporation. Series B, C, D, etc. These are the follow-on rounds, once a company makes the transition to being a professionally managed operating entity. Cap table. The cap table is short for the capitalization table. It is the official list of all the shareholders in a company and how much they paid for their shares. The above funding rounds represent the people that populate the cap table. Exit. This is the event that represents the big payday for early investors and founders. An exit is either an acquisition or an IPO, initial public offering. An IPO is where a company gets listed and traded on a stock exchange and sells shares to the general public. IPOs are relatively rare. The more usual exit is an acquisition, where the startup is bought by an established company to add to its portfolio of offerings or for some other strategic reason. The purchase price of the company is split among the various shareholders, and the value of their pro rata portion is what determines their return on their original investment. The exit is the endgame goal of venture-backed startups.